Welcome everyone to this webinar on our new report, Financing the ASEAN Power Grid. My name is Cecilia Tam and I head up the Energy Investment Team at the IEA. This report was made possible thanks to the IEA's Clean Energy Transitions Program that enables the IEA to support clean energy investments in emerging and developing countries. I'd like to thank all of our partners from various ASEAN member states, financial institutions, industries, and international organizations for sharing their expertise and insights with us during the various consultations that we've held over the last year in preparation of this analysis. The IEA has a long history of collaboration with Southeast Asia and extensive analysis in the region across the energy system. Our biannual Southeast Asia Outlook was first produced in 2013, and we're currently working on the 6th edition of this report. Our long-standing partnership with the region continues to grow, and last year the IEA opened the Regional Cooperation Center in Singapore, bringing the IEA closer to its partners in Southeast Asia. This report was developed by the IEA's investment team and the Regional Cooperation Center. ASEAN has a long history of electricity system connectivity, and the development of the ASEAN Power Grid is key to achieving a sustainable, secure, and affordable transition for the region. With momentum growing to build the next 5 years will be critical to scale up investment and accelerate implementation. The IEA will continue to support the ASEAN Power Grid Initiative and the region's energy objectives in the coming years. Before report authors take us through the findings, I'd like to invite my colleague Suern Tan, head of the Regional Cooperation Center, to provide brief remarks. Suern?
Thanks very much, Cecilia, and thank you to everyone for joining this webinar. So I'd just like to take a minute to share some scene setting and a bit of context and 3 key points. So first, over the past 2 decades, we have seen the importance of our power systems expansion in playing a key role in driving economic growth, expanding energy access, and really supporting industrial development across ASEAN. And the electricity demand in the region is expected to grow at about 50% faster than the global average. Second, how do we meet this demand? We will need significant investment in both generation and grid infrastructure across the region, but we also need deeper interconnections to enable countries to connect low-cost generation with demand, enhance the system flexibility, and share resources. The ASEAN Power Grid is therefore not only an infrastructure initiative, it is an enabler of a more secure, resilient, affordable, and sustainable regional power system. Third, as mentioned by Cecilia, we should recognize there has been very good positive momentum on the ASEAN Power Grid, supported by sustained leadership from successive ASEAN chairs, as well as a strong commitment from member states. We've also seen commitment and action from multilateral organizations, development partners, and the private sectors. And this has been reflected in the recent milestones such as the Lao PDR, Thailand, Malaysia, Singapore, LTMS, Power Integration Project, as well as the Enhanced APG Memorandum of Understanding and the establishment of the APG financing facility last year at the ASEAN Ministers of Energy meeting. So many of the key ingredients are now in place. As Cecilia says, the next few years will be critical to translating this momentum into investment and implementation. And that is a key lever where finance can play a role. This report from the IEA really aims to contribute by providing an assessment of investment needs, but more importantly, a set of practicable and actionable recommendations to unlock financing for cross-border infrastructure. I really want to acknowledge Cecilia and James and the other colleagues from the IEA Energy Investment Unit who led this work and really had the vision for it. As Cecilia said, the IEA remains committed to working with our external partners, all of whom have provided valuable insights to help shape this report, and collaborating in the years ahead to support the implementation of the ASEAN Power Grid vision. With this, I'd like to hand back to Cecilia.
Thank you very much, Suern, for helping to set this regional context. I'd like now to introduce the report authors, James Bragg, Yinling Teng, and Inshin Wong, to present the report findings. After presenting the report, we will have a Q&A session, and I invite participants to submit their questions on the report via the Zoom chat function. The report is available on our website, and we will also make today's presentation available to participants. I'd like to now invite James Bragg, who led this report, to kick off the presentation.
Great. Thanks, Cecilia, and thank you to Sue Earn for the introductory remarks. Let's jump right into the presentation. I'm going to begin by just providing a sense of scale and an overview of some of the investment needs for the APG. Of course, having problems with my clicker. Just one moment here. Let's see if this works. Voila. Okay, so I wanted to begin the presentation by first looking at an existing interconnector in ASEAN today. What you're looking at here is the approximate location of an interconnector between Singapore and peninsular Malaysia. This is the Plentong to Woodlands line. And I chose this line as an illustration for two reasons. First, it is one of the oldest existing interconnectors in ASEAN, built all the way back in the 1980s and recently renovated in the past few years. But second, because today it remains the only operational subsea interconnector in the region. When we compare the Plentong Woodlands interconnector to more recent projects, more recent interconnector projects that we've seen in regions such as Europe, it is quite small in scale. And so what we've done here is compared it to size to a recent interconnector, that's the Viking Link connecting the United Kingdom from Denmark, which was recently built. This interconnector is currently the world's largest subsea interconnector with a subsea segment of 650 kilometers. And it really gives you a sense of the scale of these new types of projects where, thanks to HVDC technologies, we can really stretch the boundaries of the project distances while still making them or having them be economical. So why do I say that the ASEAN power grid is a step change in ambition? Well, if we look towards the project pipeline, it becomes much more obvious. If the ASEAN power grid were to be magically built overnight, Southeast Asia would be home to the world's four largest subsea interconnectors, those including lines between Singapore and Sarawak, Vietnam and Cambodia, as well as a domestic interconnector between Kalimantan and Java. So when we say that the ASEAN power grid is a step change in ambition, it's certainly a step change in ambition for the region, but also by global standards, this is an incredibly ambitious initiative and really underscores the need for crowding in different solutions and different sources of capital to make this initiative a reality. Of course, the region is not starting from scratch. We make this very clear in the report, and we spend a lot of time diving into some of the first interconnector projects all the way up to the present. But what you're looking at here is a map of some of the existing domestic interconnectors, cross-border interconnectors in the ASEAN region. And so there is clearly a foundation of existing infrastructure to build from. The APG can be split up into three subsystems. The first is the APG North, including Myanmar, Thailand, Cambodia, Lao PDR, and Vietnam. And as you can see here on this map, that is historically where most development of interconnectors has taken place and is where most international or bilateral electricity trade takes place in the region today. On the other hand, we have these two other subsystems, the APG South, which includes Singapore, Peninsular Malaysia, Indonesia, as well as the APG East, including Kalimantan in Indonesia, Sabah, Sarawak, Brunei, and the Philippines, where to a large extent, many of these countries and their individual regions within them remain unconnected to neighboring countries and to the wider subsystem. So really, when we talk about the APG today, as it stands, it's a much more fragmented picture, which is to be expected as the region sort of progresses along a stepwise approach towards multilateral power trade. But nonetheless, it signals that we're expecting to see a lot more investment shift towards other subsystems in the future. When we look back and we quantified investment from the first projects, which began exporting electricity from Laos to neighboring Thailand and Vietnam, we quantified that approximately $2 billion has been invested in interconnectors from the 1970s all the way up to 2024. But when we look at the project pipeline and the investment that is required to build an APG, we're looking at a really large step change in the total investment needs in order to build these projects. So in total, cumulative investment over 2025 and 2040 is expected to be approximately $27 billion by our estimate. And so we're looking at annual investment over the next 15 years that is almost as much as what the region has invested over the past 50 plus years cumulatively. So this is a massive step up in ambition, as I was saying. Now, moving on to what are some of the drivers of these higher costs or greater investment needs, and what are some of the key characteristics of the project pipeline which help to inform our identification of the key challenges and priorities for the region. Let's start with the project's physical characteristics. So historically, as is probably expected from some of the previous slides I presented, we're expecting to see quite a big increase in the line length of the average project in the upcoming pipeline. So historically, the average project length was 81 kilometers. Over the next 15 years, the average project length is going to more than double to about 200 kilometers. But it is not just size. We also need to look at the costs involved for these projects and the type of technologies that are being used. Historically, the cost per kilometer of interconnectors in ASEAN for all the projects that we looked at was approximately $0.4 million per kilometer. This is because in the past, most interconnectors have been built on land and using relatively low-cost, proven HVAC technologies. Whereas if we look towards the future, when we're expecting a lot more cables to be used, in particular using HVDC technologies, which involve much more capital-intensive equipment, such as converter stations. If we express these costs on a per kilometer basis, the average cost per kilometer, we're expecting to increase more than fivefold to about $2 million per year. And so really it is the change in both the size of the projects as well as the technologies used, which are a major driver in investment needs moving forward. But I really want to hone in on the characteristics of this pipeline too, because this is key. Historically, what we found in the report is that most investment to date, about 85%, has gone towards generation to grid projects. And these are projects used to facilitate electricity export from a single source of generation or a cluster of generators, whereas only 15%, which you see here on this slide now, has gone toward these grid-to-grid projects, which are really the focal point for APG planning and seen as the key enabler for multilateral power trade in the region. If we look towards the future of the pipeline, this really flips on its head. The majority of spending, so 60% of that $27 billion expected, is going towards these grid-to-grid projects. And so it's absolutely essential that the business models for electricity transit, as opposed to electricity generation plus transit, as seen for generation and grid projects, it's really important that there's a clear business model in place for these grid-to-grid assets moving forward. And then finally, this is related to previous slides as well too. As expected, only 1% of historical investment was on subsea cables historically. If we look towards the future, again, we see a complete tilt change where 85%, so the vast majority of investment, is actually going to be for projects involving subsea cables. And as my colleague Ying will dive into in a little bit more detail on subsequent slides, these subsea cable projects, they demand a different approach to the financing models moving forward. And they also have different implications for risks and risk management. So with that, I'm going to hand over to my colleague Ying, who's going to talk more about the business models and financing models.
Thank you, James. So as we heard, developing interconnectors is not only a technical challenge, it's also a finance and investment challenge. And therefore, in the next section, we'll discuss the risk management, financing models, and commercial arrangements used to deliver interconnectors and how they might evolve and scale in the future. As discussed, most future investment is required for subsea cables in the pipeline. They come with a distinct risk profile, which has implications for project bankability, timelines, and cost of capital. This slide shows how the risk profile varies across different risk factors and across the project lifecycle for subsea interconnectors. So there are 5 key categories which we'll look into. First, political and regulatory risks. So particularly where cross-border regulatory frameworks are still evolving, where there's uncertainty around revenue mechanisms and market rules, this can create uncertainty for project investors. Secondly, on technical and physical risks. Subsea cables in this region can pass through shallow waters, congested shipping lanes, and geologically active areas. This creates risks across cable installation and operations. So in the event of cable damage, repair timelines and downtime can be long, and this can lead to long business interruption and high business interruption and repair costs. This is further exacerbated due to limited availability of specialized cable laying vessels. Thirdly, permitting and access risks. Subsea projects may require different permits for each jurisdiction that it passes through, and for the onshore, nearshore, and offshore portions of the project, and may also require additional export or import licenses. This introduces complexity and potential risks of delays, and this is further complicated where cables pass through third-party waters. So these are the 3 major risks. Off-taker and currency risks must also be considered, particularly in multi-country projects, which involve multiple counterparties and multiple currencies. So these risks require strong end-to-end risk management, which should start early from the design stage of projects, with early engagement with technical experts, advisors, and insurers. During project structuring, risks should be allocated to the parties best placed to handle them, and residual risks can be further mitigated through instruments such as guarantees or insurance. Governments, development finance institutions, financiers, developers, and insurance companies can all play a role in managing risk. So with the next slide on financing models, we explore the question of who has been financing interconnected projects. Overall, around 60% of investments to date have been delivered under a state-owned enterprise-led model. This means that the utility, which in most ASEAN countries are SOEs, is the sole owner and operator of the interconnector line. Financing is consolidated on the SOE balance sheet, and the terms of financing and access to capital is directly linked to the financial health and liquidity of the utility. This is the model used for almost all grid-to-grid investments to date. Generation-to-grid projects, in contrast, has attracted more commercial financing, and this is primarily where the developer of the generation asset also develops the cross-border transmission line. As discussed, the majority of future pipeline investments will be into grid-to-grid projects, to the tune of almost $16 billion of investment to 2040. If grid-to-grid projects continue to be predominantly delivered through the SOE-led model, this investment requirement will fall squarely on SOE balance sheets. This is in addition to even larger investment requirements for domestic grid expansion and strengthening. And this may present a challenge to some utilities in the region where there are financial pressures and limited lending capacity. So diving deeper on the specific financing models, this schematic shows an SOE-led model where the state-owned utilities play the central role in interconnected development, and it illustrates a power trade between country A on the top half of the page and country B on the bottom half. All SOE-led projects in the region have been delivered under a split project model. What does this mean? The interconnector is split at the border, and each utility is responsible for financing, developing, owning, and operating the portion of the project within their own borders. So it's financed as 2 projects. The commercial arrangements required in this model are quite straightforward. Only a single power payment is required between the two utilities, perhaps structured through a power purchase agreement. And there's no separate payment for transmission services required, and this is implicitly valued. The SOE model is pretty well established for overhead lines and can be delivered fairly quickly under current regulatory conditions. And it can be most appropriate for smaller projects and where the utility does not face constraints in raising financing. However, larger and more complex projects demand a more collaborative approach to financing. So the next slide shows an independent transmission project model or ITP model. These are an important option, particularly for long distance and costly subsea interconnectors and where more attention needs to be paid to cost allocation and risk allocation. This model has been applied widely in other regions, such as in Central America, Africa, and in Europe. So again, this illustrates the power flow from country A to country B, but this time the interconnector asset is developed by a special purpose vehicle, or SPV. This is a separate legal entity established for the purpose of developing, owning, and operating the interconnector asset, and would typically receive a long-term concession from the state to carry out this purpose. Ownership of the SPV can vary by project, but it can be from a mix of public and private sponsors, and it's also possible for more than one country to share ownership of the asset as a true cross-border project. So what are the benefits of this model? Financing takes place on a non-recourse basis, meaning that lending depends on the financial viability of the project itself rather than the underlying sponsors. It can facilitate revenue and cost allocation between different investors through adjusting the ownership shares in the SPV. And project risks can also be ring-fenced through the SPV structure and allocated across different parties through contracts. However, this model can be slower to implement and requires alignment of interests and contracting between multiple different parties. And in some cases, ownership restrictions can also limit where this model is applied. It's important to note that regardless of the financing model, the operation of the transmission system itself is retained by the transmission system operator, so that does not change. Now let's look at the commercial arrangements for the ITP model. In this situation, a single power payment is not sufficient, as the interconnector owner must also be able to recover their costs and whether our private parties make an acceptable rate of return. An additional payment is required for transmission services, and this can kind of take many options. Some options that have been applied globally include utilization-based payments, which is a payment made based on the amount of electricity flowing through the interconnector. Availability payments are another option, which would take the form of a fixed payment determined through regulation, provided for ensuring that the interconnector asset is available to be utilized when required. And this provides a bit more of a predictable revenue stream compared to utilization-based payments. There are other models such as congestion charges and capacity auctions, which have been mainly applied in places such as Europe with wholesale markets. Whichever model is chosen for the region, it's important to ensure that it's aligned between the participating countries and made transparent to market participants. So the next slide illustrates what commercial arrangements look like as power trading scales. So to date, power trade has relied on bespoke PPA contracts and wheeling contracts, which are negotiated on a case-by-case basis. So the previous slide illustrated a simplified case of power trading between two countries through one interconnector. And this is relatively straightforward to deliver through these commercial arrangements. However, complexity does increase where the number of market participants increase. For example, if there are more interconnectors or more countries participating in power trade, or where there is wheeling through transit countries. As complexity increases, it's challenging to scale through bilateral contracts. So as the number of market participants increases, the number of contracts required also increases, which comes with high transaction costs. And with contracts, there's also limited transparency in some cases, with the risk that market participants would not receive equal treatment. And these factors all prevent participation and scale. So what are the options to resolve these barriers? In order to achieve scale in the region, commercial models should move towards becoming more predictable and more harmonized. So instead of being established through bespoke contracts on a case-by-case basis, they can be guided by rules or regulation. And through this, ASEAN can create commercial models that can scale and attract new sources of investment. This choice of financing model and commercial arrangements have very real implications on project bankability, and I'll hand over to Incheon to discuss further.
Thank you, Ying. Let's now turn to bankability and financing. So in this section, we analyzed whether the current market conditions can support financing ASEAN interconnectors at the needed scale, and if not, what needs to change to enable that. So let's start with the role of state-owned utilities. As we mentioned earlier, the interconnector delivery in ASEAN today is still heavily reliant on state-owned enterprises' balance sheets. But what this slide shows is that balance sheet capacity varies significantly across the region. As we all know, ASEAN is not a single market. It is highly heterogeneous. We see differences in credit ratings in both sovereign and state-owned utilities, cost of capital and sovereign bond yields, FX volatility and macroeconomic stability, and ultimately the state-owned utilities' borrowing capacity. For example, utilities in Singapore and Thailand operate from relatively strong balance sheets with low leverage and strong cash flow coverage. However, the others often face much tighter constraints with higher leverage and weaker cash flow metrics, which could directly limit their ability to take on additional large-scale transmission investments. So while balance sheet-led delivery could work in some markets, it is very difficult to argue that this is the sole model for a regional system at this scale. And the reason is not only financial. There are often broader system constraints that affect the broader state-owned enterprise's balance sheet. At the government level, large interconnector investments mostly compete with other national priorities, such as subsidies, social spendings, and other domestic priorities. At the utilities level, state-owned enterprises are also responsible for maintaining tariff affordability, expanding domestic access, and supporting national energy policy. So this means that their capital allocation is often constrained and may have different priorities, and which is why complementary financing models becomes essential in the region. Next slide, please. So let's now turn to the financial modeling analysis. So to assess bankability in the region, we built a project-level cash flow model for a representative ASEAN interconnector based on real project characteristics and regional benchmarks. So this model incorporates capital costs based on recent interconnector projects and supply chain conditions, a standard construction and operating timeline, and a capital structure combining equity and long-term debt available in the market. On the revenue side, we tested different commercial frameworks, including availability-based payment and utilization-driven revenues. And on the financing side, we tested a different cost of debt, different debt-to-equity ratio, and access to concessional versus commercial financing. Then, as you can see on this slide, we did run 3 scenario analysis. The first one is a cost reduction case reflecting strong domestic and international policy support, concessional finance, and efficient project delivery. And then the base case shows realistic ASEAN conditions today, and a cost overrun case capturing higher financing cost delays and weaker revenue structure. So the modeling shows a very clear message. In the upside case, you will see the equity IRR reach over 20% range, which is fully competitive with global infrastructure and energy investments, not only in the region, but also globally. In the base case, you will see the returns would fall to around 10 to 11%, which is still sufficient for SOEs and most infra-seeking long-term investors. In the downside case, the returns would drop to around 5% for equity investors, which is not always investable for most commercial investors. So the key conclusion here is interconnectors are not inherently unbankable, but their bankability is highly dependent on first revenue design and financing conditions, and then the broader policy environment. So this means the returns are often policy-driven, not asset-driven. And this is where the policymakers and state-owned enterprise could play a central role on financing ASEAN interconnectors. Next slide, please. So we also tested a range of technical financial variables in the model, including tariff levels, availability payments, utilization rates, interest rates, O&M costs, and any other system losses for T&D. We won't go into details here, but the key takeaway is revenue structure and financing terms are the dominant drivers of returns for ASEAN interconnectors. Technical improvements, such as reducing T&D losses and optimizing O&M, have relatively limited impact on bankability as soon as the project IRR is positive. So again, the implication is clear. This is primarily a policy and financing challenge, not necessarily a technical one. Next slide, please. So these slides break it down more explicitly. Starting from the base case, we show how different levers increase equity IRR. You can see the three factors clearly stand out. First, revenue and tariff design. You can see a 10% increase in tariff could potentially raise equity IRR by around 1.6 percentage points. But more importantly, it's not just this level. It's about the structure around the revenues. Increasing the availability-based payment, which will make the return more predictable, and the cross-border revenue allocation become much more suitable. These are critical to reducing demand risks and enabling long-term financing, both for the project developer and equity investors. Second, cost of capital. Reducing the borrowing costs from commercial level to commercial and concessional blended level could add potentially 2% IRR increase for equity investors. This is where multilateral development banks, development finance institutions, other export credit agencies could play a central role by providing a long tenor, lower cost, and risk mitigated capital that commercial banks cannot match. Lastly, financial structuring. Higher leverage and improved financing terms could enhance the return. And importantly, these are the areas where public financiers and policymakers can actively intervene and shape the outcome. As we've seen in the previous slide, by contrast, technical improvements such as faster construction or lower T&D losses have incremental but relatively limited impact. So the conclusion here is very clear. Bankability is driven far more by financial structuring and revenue design than by engineering optimization. And this leads to an important implication, which is the challenge is not often technical, it's policy-driven and financial. So stepping back, what does it mean for ASEAN? First, state-owned enterprise-led delivery model alone is insufficient at scale, given balance sheet constraints in the region and competing priorities across the ASEAN. Second, interconnectors are economically viable assets, but only under the right enabling conditions. Third, most powerful levers are revenue certainty through well-designed tariff frameworks and affordable long-term financing. If these conditions are implemented, ASEAN can move from a project-by-project approach to a scalable regional market for interconnectors. And ultimately, that's what will unlock delivery of the pipeline at scale. With that, I will now hand over to James, who will walk through the key recommendations.
Thank you so much, In-Chen. So we're approaching the end of the presentation now. I'm going to conclude with our 7 key priorities for the report. At that stage, or at this stage, I would please recommend all the participants to submit any questions to the Q&A through the chat if you have any, so that we can round these up and get to them in the Q&A session. But in our report, we outline 7 key priorities that we think are really needed to scale interconnector investment, and they're shown here on this slide. So I'm just going to take the time to quickly go through them one by one. So the first is strong institutional leadership is essential to kickstart project development. Embedding interconnector projects in national power sector and investment plans ensures they're assessed alongside other priorities and create better clarity for investors and manufacturers. But public leadership is especially vital at the early stages of the project. During preparation and permitting is where state involvement is absolutely essential. The second is to establish transparent, harmonized, and predictable commercial arrangements. We would advocate that the region moves away from purely bespoke contracts towards regulatory frameworks which support cross-border electricity trade. A regional approach to transmission charges and the use of availability payments can help scale electricity trade and boost investor confidence. Number 3, explore and apply alternative financing models. This is especially true for subsea projects. Shared ownership structures and independent power transmission projects or models can boost collaboration, fairly distribute costs and benefits, and attract new sources of capital. And regional funding can also be explored for projects which bring benefits beyond the countries that are immediately hosting the asset. Number 4, tackle key investment risks to reduce the cost of capital and improve bankability. As we know, as Ying described already, risks, simply put, are quite elevated for subsea cables. So strong end-to-end risk management is essential across project design, risk allocation, and mitigation. Credit enhancement instruments such as guarantees can further mitigate political and off-taker risks, but insurance is critical for costly subsea projects as well. Next, deploy international public finance strategically. Targeted support from MDBs, DFIs, and ECAs can bridge financing gaps, strengthen project preparation, and offer long-term funding solutions. And we think that successful demonstration projects can also help to establish bankable and replicable models that private capital can help scale in the future. 6, enable capital recycling through structured exit pathways, allowing early-stage investors to redeploy capital into new projects. This can be achieved by allowing minority stake sales to institutional investors and creating regional platforms to consolidate operational assets into secondary markets. And last but not least, strengthen supply chain coordination and development. Early engagement with equipment suppliers, long-term framework agreements, and coordinated procurement across the region can help secure volumes for critical equipment when supply chains are currently quite tight. Also, investing in regional manufacturing and workforce is really an opportunity to capture local and broader regional benefits from the APG for industrial development and from the standpoint of jobs and employment. So with that, I'll close the presentation and I'll hand over to Cecilia to moderate the Q&A session.
Thank you very much, James, Ying, and Inshen for this excellent presentation. So let's start with the question to Ying around SOE balance sheet. A couple of participants have submitted a question that's really asking around whether some of the SOEs in ASEAN actually do have adequate bandwidth on balance sheets to finance these presentations. So if you could please elaborate more on the implications of SOE balance sheet capacity to support the bankability of interconnector projects based on this financing model, and also if there is any approach from international experiences to helping address this challenge. Ying?
Yeah, thank you for the question. So on the kind of SOE balance sheet slide, which Inshen presented earlier, firstly, we kind of focused mostly on the SOEs, which are kind of typically responsible for developing domestic transmission grids. So we focused on those for analysis. I acknowledge that there can kind of be other SOEs involved in projects as well. For example, as sponsors in generation to grid projects. So there are kind of various options for SOE participation. In terms of the implications for the bankability of interconnected projects, I guess the constraint is where SOEs are kind of highly leveraged. They may have trouble in some instances taking on more debt on their balance sheets, and therefore that presents a constraint to the extent to which they can scale investments if they use the balance sheet financing model. And kind of leverage ratios are not the only thing to consider here. It's kind of quite a nuanced picture. I think it kind of also depends on kind of who you're taking lending from. Often we kind of hear reports where if utilities might not be able to take on further lending from domestic commercial banks because they're approaching single borrower limits in some jurisdictions. And there has also been a history of multilateral development banks and development finance institutions lending additional support to SOEs as well. But one of the other kind of points that we discuss on our report is that sometimes interconnectors and grids can be ineligible for climate finance, and that's due to kind of how they're treated in taxonomies. And there are organizations such as GGI who have kind of produced alternative approaches to climate finance for grids, which might also help to ease some of the lending constraints as well.
Thank you very much, Ying. So next question to my colleague James. One of the attendees asks whether this report will be shared with the ASEAN Center for Energy that is handling a lot of the ASEAN power grid conversations. Is the IEA report supposed to be an independent analysis, or is it intended to align with the assumptions used in the ACE models? Both have their benefits, but what is the approach that the IEA is taking on this?
Yeah. So that's a really great question. So this is an independently developed report, but we have been in close conversation with the ASEAN Center for Energy throughout, and we received some really valuable inputs from them throughout the course of this project. And they also agreed with us that this project provides a lot of additional value. We didn't want to make the outlook or the picture moving forwards more confusing. So what we tried to do here was align as closely as possible to the AIMS3 Master Plan Priority Interconnector projects as possible. So everything that is envisaged or detailed in ACE planning documents, all those projects are included in our modeling work. I think the only, 2 points of departure would be first, we've added some additional projects which more recently were announced. So that might include projects connecting Peninsula Malaysia to Sarawak. Or other various generation to grid projects which came on our radar over the past few years. So our project list is potentially a little bit bigger. It has a lot more generation to grid projects. And the other point of departure, I suppose, would just be that we're taking into consideration a lot of more recent information on project costs. So over the last few years, we've seen a lot of supply chain tightness and increasing prices for cables, for transformers, and other critical grid equipment. And so our investment estimates try to reflect the current state of supply chains and provide sort of a more realistic, not more realistic, but a more up-to-date costing of what these projects will be. So overall, this is not sort of a new competing scenario to ACE. We try to make this as close to them as possible.
Thanks very much, James. Next question around the DFIs and philanthropy. Also going to merge with one on MDBs, and this one is for Incheon. Given the huge quantity of capital required and the risk profile of the APG, especially for subsea cable infrastructure investments, what do you see as the role of philanthropies or development finance institutions or other funders in the ecosystem to help support investments in the APG ecosystem? And if you could answer that, combining with the following question around, are we sure that there's still long-term cheap finance available through MDBs and DFIs to really help lower financing costs? Incheon?
Thank you so much. This is a great question. And I think regarding the technical challenge, I think this is more of a risk allocation problem. And that's a very fair question. And especially for the cost overruns, especially for subsea projects are real. But I think this can be managed and mitigated upfront through either EPC contracting structures, contingency buffers, and insurance, and early supply chain locking and project preparation. And I think this segment of the development risk and then the construction risk can be something that philanthropies and more concessional part of the DFI and MDB's capital could play a role to de-risk these projects for investors. Because for commercial lenders and a lot of commercial equity investors, they wouldn't be able to look at this project unless the project is relatively in a good shape. So usually the construction period is completed, it's ready to complete the COD. So I would say that's something that philanthropists could play a role. Regarding the availability of long-term and cheap affordable capital being available in the region, I think we've seen recently a couple of initiatives launched by a regional ASEAN Development Bank and also World Bank to target specifically for clean infrastructure and interconnector projects in the region. And I think there are also a couple of other both philanthropic and then MDB level initiatives where they aim to blend both the concessional capital and their usual pot of capital together, to blend it together to offer these projects a much more affordable loan compared to their usual product. So I think there is a political will and these institutions are willing to move forward towards that direction. But ultimately, this will determine at their long-term strategy level, which I think policymakers and various MDB stakeholders could play a role to prioritize scaling ASEAN interconnectors.
Thanks very much, Incheon. Next question to Ying. One of the attendees asked, do generation to grid and grid to grid projects face different financing challenges? While the number of generation to grid projects is larger, it seems like the priority will be placed on grid to grid projects.
Yeah, good question. So yes, they do face different financing challenges. I would say that maybe the biggest difference is in terms of the revenue model accorded to the project. Generation to grid projects are developed as a generation asset alongside a transmission line. So in that case, most projects so far have been delivered through just having a PPA between the project developer and the importing country. And that's been pretty well established in the region. Grid-to-grid projects, on the other hand, often there's in the region there's kind of not really any form of harmonized or aligned transmission charging methodologies. Wheeling charges are usually kind of agreed on a case-by-case basis, and often the kind of actual revenue model that you can apply for grid projects does not exist or is sometimes quite unclear. So I would say that that's the main challenge. And I just want to say, even though that there are kind of more grid-to-grid projects in the pipeline in the future, generation to grid projects will also continue to play quite an important role in kind of supplying power to demand centers, whereas grid-to-grid projects provide those benefits, but also provide further benefits for system resilience and security.
Thanks very much, Ying. Next question to James. Each of the ASEAN countries are in different degrees of market liberalization, and to enable a harmonized multilateral power trade agreements. Should there be an ASEAN roadmap working towards that? And when do you think ASEAN will be ready for that market?
It's a great question. It's a tricky one. We know today that, of course, ASEAN is home to a great mix, and there's plenty of heterogeneity in terms of power market structures and market design in ASEAN. And so interconnectors, have the challenge of cutting across all these different markets and trying to, square the circle on different approaches to tariff design, to subsidization, etc. I would say, however, that sometimes we've found, at least in writing this paper, there is a bit of a misconception that, establishing a sort of a regional or harmonized approach to electricity trade requires full trade liberalization for all participants involved. In fact, in our report, we outline different examples, such as the West African Power Pool or the CPAC line, where countries can maintain different market structures, different approaches to price setting, while still establishing a harmonized and regional approach, sort of a secondary market specifically for electricity that is traded across borders without actually changing their internal market structures. The pathway to market liberalization is, it's a political choice fundamentally. It's up to the discretion of each country. And that timeline is going to vary. Countries today are at different levels of maturity. So we think that, even though in the absence of sort of there being a common liberalized market across countries in ASEAN today, we can still make clear steps forward in implementing a regional approach for interconnectors.
Thanks very much, James. The next question I'd like to ask Inshin. For smaller or lower income ASEAN countries, what is the most realistic first step to attract financing for cross-border transmission without waiting for full regional market integration?
Thank you for the question, and it's a really good one. I think for smaller or lower income countries, the government must have a competing different national priorities, but I think it's important for them to show a clear and predictable revenue mechanism to be in place for financing interconnectors, either for domestic or for regional or multilateral development banks. And after having this strong government support, I think this is the area where multilateral development banks and DFIs and even philanthropists could step in to involve early on in the project, to anchor this project, to provide the long-term debt, if permitted, also equity, and provide risk mitigation. And I think once the project becomes operational, then this could be used as a demonstrational project to attract more commercial players or market players in the region as a stepping stone to become more connected for other interconnector projects in the region.
Thank you very much, Inshin. We have a couple of questions submitted around the role of renewable energy certificates. Perhaps, Ying, if you could just quickly touch upon the role that RECs have played in the analysis.
Sure, thank you. This will be quite a quick response because this wasn't the focus of the analysis. But we do acknowledge that there's kind of quite a bit of interest in the region in terms of cross-border RECs and how they might support the development of power trade and clean power supply to corporates. And this is an area that's kind of interest to us going forward. So please feel free to reach out to us to discuss this one further.
Thanks very much, Ying. To James, I'd like to ask this question that's come in around would an SPV model comprising financial institutions and financiers work for the APG investments? The attendees, participants' view is that it would not, as the returns are not immediate and there is no quick financial payoff. What is your thoughts on that?
So I think it could. And we actually can point to concrete examples where it has already happened. So Europe is probably the most advanced in terms of the number of interconnectors, but also on business development for interconnectors to be expected. But we have a few examples already. One is the Greenlink interconnector between Wales and Ireland, which was, set up as its own company, completely privately financed as well too. That's already operational, although it is using more of a congestion business model. So it's taking advantage of price arbitrage to really earn a return. And then we also have another being constructed right now. It's called the New Link between the United Kingdom and Germany. And there again, privately financed, and it's actually deploying institutional capital as well too. I think it's Allianz Capital Partners who is helping to finance that. I think Inshan's analysis in this report, although it's dialyzed in some ways, I think it really does nail the point that actually there's nothing structural or inherent about these assets that make them unbankable or unsuitable for a particular type of investor. If you have the right business model in place, we think the most promising one would be some form of availability payment given the current power market structures in ASEAN. If you have a payment structure like that in place, I think these assets can be attractive to different types of investors. And indeed, when we were doing consultations throughout the course of this report, we did speak with different types of investors who did signal they are quite interested in this space. So I think the answer is actually yes, they can. And the SPV framework makes financing a little bit easier when it comes to ensuring a sort of a fair allocation of costs and benefits and ring fencing financing. But a lot of institutions that we spoke to said the main issue really is just that they don't have an entry point. It's either due to the regulatory legal environment that's preventing private ownership of interconnector assets, or these assets are just not the type of financial assets that an institutional investor like a pension fund would really be able to invest in because it's not super liquid. So yes, it's possible. There's just a bit of work to do, I think.
Thanks, James. Next one to Inshan. It looks like there's quite a bit of significant risk imbalance here, with cost overruns affecting bankability being likely caused by technical or engineering factors, but improvements to bankability are driven by non-engineering factors. And it seems that the former is more likely to happen due to substantial subsea segments. How can these be better managed?
Thank you for the question. So that's the right framing, and I describe it as less as an imbalance and more as a two-sided risk management problem. So we have at the technical side and the financial side. I think on the technical side, you're right. Subsea interconnectors are relatively new and it has real risks, including cost overruns, and installation gets really complicated. And there could be potentially other supply chain constraints. But I think in the project finance terms, these risks are actually quite well understood and largely manageable through right structuring. So when it comes to EPC contracting, you can discuss a couple of things such as fixed price or turnkey contracts with you need to select experienced contractors for this specific type of technology, and plus some sort of performance guarantees. And it is recommended to include also contingency and insurance relevant for this type of technology, including marine risks and delay in start coverage. And if you are concerned about the supply chain issue, you can look into early procurement to lock in some of the supply chain items to reduce exposure to price volatility. On the financing side, I think the bankability is mostly driven by factors that are within the policy and macro level control. One, as we mentioned, the revenue certainty through tariff and potentially through availability payment. And you can also structure the project in a different way. Who would take construction risks versus the demand risks? And then by providing access to long-term tenor. So I think we view that if both sides are addressed and with the right type of risk measurements, even complex subsea cable projects become bankable within the ASEAN context.
Thanks very much, Inshin. Yang, I'm going to merge two of the next questions for you. If ASEAN governments, policymakers had to prioritize developing just one or two needle-moving initiatives to enhance the bankability of interconnector projects, what would those two initiatives be? So perhaps also just elaborate on the requirements of regional legal and regulatory frameworks to really enable regional power trade to reach bankability.
Yeah, thank you. I think I'll first start by saying that there are already kind of many initiatives going on at the ASEAN level, the development of the subsea cables framework and the ASEAN Power Grid financing initiative, both of which are ongoing and are super important to progressing the APG. If I had to add one or 2 points onto that, I think one, as we discussed in the presentation, moving towards more aligned commercial arrangements. It doesn't necessarily have to be the same methodology for all countries in ASEAN, but even starting from 2 or 3 countries or a subgrouping of countries, and making the transmission charging methodologies, the wheeling charges, kind of transparent and a bit more standardized than it is today. That could be very needle moving. And then the second one, which we haven't had too much time to discuss just yet, is in terms of the regional supply chain. So many of the cable components, especially for direct current cables, are imported and manufactured from other regions. I think there's a kind of a really interesting opportunity for ASEAN to explore how you can attract some of that manufacturing into the region and to really start the dialogue with manufacturers there. And there are kind of already some initiatives on that which have recently been announced.
Thanks very much, Inshin. James, as the APG becomes increasingly interconnected and interdependent in the future, many of the countries in the region will face increasing exposure to climate-related hazards, such as typhoons, monsoons, and extreme weather events. Can you provide some insights into how these climate risks might affect the cost of ensuring grid resilience across the integrated network? Specifically, how might the cascading nature of climate vulnerabilities in an interconnected grid really influence financing costs, risk premiums, and the overall bankability of cross-border power infrastructure investments?
Sure. Yeah, super interesting question. Although we didn't look too much into the impacts of climate hazards in this report, I would underscore that we do have some upcoming work on the impact of climate hazards as part of a broader set of risks in a program that's going to be focused on investing in resiliency and security for the power sector. And so I would anticipate that this is one of those topics that we would cover in much more detail there. And I think there's going to be a lot of focus on the Asia region for this report. What can I say now at this point? So this is kind of a technical question. I remember doing some reading on this before. I think, yeah, I mean, the general thrust is that with a more interconnected system, you risk cascading blackouts. across different countries. I was speaking to some of our internal secondees from major grid equipment manufacturers like Hitachi. We also had conversations with other leading HVDC system suppliers. And my understanding of the technology is that actually these days it can be built such as to prevent some of these cascading effects and implement sort of fail-safes to prevent such scenarios. And actually, indeed, to create new ancillary services for countries such as Black Start. In my opinion, I think that building interconnectors is actually a way to enhance resiliency and security in the face of increased climate hazards, which are likely to increase in magnitude and risk and impact in the future for the region. Because really, this is about diversification of supply and leveraging geographic complementarity. We've had some examples quite recently in Europe, in Spain, for instance, where we had this massive blackout in the Iberian Peninsula. And really, I think a strategic response includes to an issue like that includes many different things, but interconnectors is one of those things that we emphasize as potentially providing a solution. The more interconnections that we have, the more grid strength we have as well too. And so I think actually, on the contrary, if each region can help to diversify its supply mix, I think that these interconnectors are a boost for energy security and help to insulate against climate or other physical risks.
Thanks very much, James. Next question to Inshin. How do you address foreign exchange risk given multiple currencies?
Thank you. That's a great question. So for the financial modeling exercise, we didn't reflect the FX volatility, so everything assumed to be in USD. In reality, a lot of capex will be in hard currencies versus the underlying revenues will be in local currencies. But we did look at FX market and volatility in ASEAN in the paper. Surprisingly, majority of ASEAN countries have very strong and resilient FX market against the USD, with a few exceptions when it comes to more frontier economies within ASEAN.
Thanks very much, Inshin. I'm going to now pose each final questions to our three authors. First, starting with Ying. What is on the need for revenue predictability? What were the report's findings on merchant risks versus secure private sector, public sector-led offtakes or regulated tariff floors that is needed to support interconnector capital expenditure?
Yeah, thanks for the question. So in the report, we're not prescriptive on kind of which revenue model we propose. But to try and answer the question, I think kind of full exposure to merchant risk perhaps isn't an option for much of ASEAN, as it's kind of more applicable for countries with wholesale markets. I think what is really important, no matter kind of which revenue model you're looking at, is to consider the implications on revenue predictability and stability for the investors. So we previously mentioned availability-based payments as one of the methods for kind of providing that predictability to investors. Of course, there are kind of cap and floor, regulated tariff floor levels, models used in other regions, such as the UK, where you can maybe have some variation on revenues depending on line utilization, but to kind of both cap the downside and potentially the upside as well. So I would encourage kind of ASEAN to kind of look at international experience and I think no matter which model ends up being chosen for the region, it's going to be have to decide based on the specific regional context.
Thanks very much, Ying. Final question to James. Can we really expect a role for the private sector and institutional capital given the risks involved in current legal environment?
Yeah. So I think this is quite similar to a question that I answered before on whether we can really expect SPV models to work for these assets. I think, again, as the answer is quite similar, yes, there is precedent. I would encourage people interested in learning about this by looking at actual concrete examples from Europe, such as the Green Link, the New Link, and there's many other projects that show that private and institutional capital can and is willing to take a role for interconnector projects. And as we highlight in this report, again, there's nothing inherent to interconnectors, even subsea interconnectors, that make them impossible for the private sector to get involved or for institutional capital to be interested. There's just more risks, and the business models really need to be put in place to make these assets bankable. But that is definitely possible. It's more of a decision among regulators and government than anything else. Do you want the private sector to take a role in this? Can they help support you in terms of mobilizing the investment needed for these major projects?
All right, thank you very much. We're out of time now, so I'd like to thank our three authors for sharing the findings of the report and answering these excellent questions. And I'd like to thank all of the participants for submitting these questions for our discussions. And just a reminder that we will be sharing the presentation with the participants today. So with that, I'd like to end this webinar and thank all of you for joining us today. Thank you very much.